Imagine a man who could have bought almost anything he wanted, lived a life of unimaginable luxury, and yet chooses simplicity instead. A man whose net worth climbs every year into the tens of billions, yet he still lives in the same house he purchased decades ago, drives a modest car, and eats at fast food chains. This is Warren Buffett, often called the Oracle of Omaha. But here is the twist. His wealth isn't just the result of savvy investments or market timing. Behind the numbers lies a strict moral code, a philosophy about money, ethics, and human behavior that most investors completely ignore. Today, you will learn the principles that allowed Buffett not only to amass wealth, but to do so without losing his integrity, a rare feat in an industry often driven by greed and shortcuts. And more importantly, you'll discover why ignoring this code could cost you everything, even if you hit financial success. To understand Buffett's moral code, we need to rewind to mid-20th century America. Wall Street was already an empire of fortunes, but it operated on speculation as much as skill. Brokers sold dreams more often than they sold value, and the stock market attracted both visionaries and opportunists looking for a fast buck. Buffett entered this world not as a scion of wealth, but as the son of a U.S. congressman who valued honesty and hard work. Even as a child in Omaha, he was obsessed with numbers, profit, and patterns, buying his first stock at just 11 years old. But unlike many, his early fascination wasn't about flashy gains. It was about understanding value and behavior over time. Here's the twist. The very habits that made him wealthy, patience, integrity, and careful assessment of risk, were often scorned by his peers. In an era that celebrated aggressive trading and quick wins, Buffett was quietly building a system that would outlast decades of market chaos. The story begins with Benjamin Graham, the father of value investing. Buffett met Graham at Columbia Business School and was immediately captivated by his approach. Buy businesses at a discount to intrinsic value. Understand what you own and avoid speculation. This was radical. Most investors chased hype or followed the crowd. Graham's method was disciplined, rational, and most importantly ethical. Buffett absorbed these lessons and returned to Omaha to start his first partnerships. Unlike Wall Street firms, he didn't promise overnight riches. He promised steady, informed growth. His early successes weren't headlines, they were quiet proof that ethics and patience could outperform aggression and manipulation. But here's the first challenge. Ethical investing often means short-term underperformance. While others chased fads, Buffett's holdings were criticized for being boring. Newspapers mocked his slow approach. Yet the foundation of his moral code was forming. Avoid temptation, focus on fundamentals, and treat money as a tool, not a game. By the 1970s and 1980s, Buffett's approach began to pay off in a way few could ignore. Berkshire Hathaway, originally a textile company he acquired, became the vehicle for his growing empire. Through disciplined investments, Coca-Cola, Geico, American Express, Buffett demonstrated a pattern. He bought excellent companies at fair prices and held them indefinitely. His code was simple yet radical. Never invest in something you don't understand. Avoid debt and speculative ventures. Align with management teams who share your ethics. Each investment decision reflected not just financial calculation but moral judgment. Buffett famously avoided industries he deemed unethical, like tobacco and defense, long before ESG investing became mainstream. The rise was meteoric, but quiet. Unlike Wall Street moguls flaunting yachts and mansions, Buffett maintained a humble lifestyle. His moral code wasn't a marketing strategy, it was a principle that governed every choice, and it compounded as powerfully as his portfolio. Of course, no system is immune to challenges. The late 1990s brought the tech bubble. Dot-com fever swept investors into speculative mania. Stocks with no earnings were valued at billions. Conventional wisdom said, ride the wave or get left behind. Buffett resisted. He labeled the craze irrational and avoided the hype. Investors mocked him for missing out on the biggest gains of the decade. Some saw him as outdated, inflexible, or even risk-averse. Yet when the bubble burst in 2000, Buffett's disciplined approach shielded him and his shareholders from catastrophic losses. This was the breaking point, not just for markets but for his philosophy. The lesson was clear. Ignoring moral discipline and succumbing to greed can destroy even the most promising investments. Buffett's restraint, born from his ethical code, was the key to surviving an era of mass hysteria. The aftermath revealed a shocking truth about modern investing. Many funds and investors who chased tech gains lost years of progress. Hedge funds collapsed, pensions shrank, and ordinary investors were devastated. Buffett, meanwhile, continued to grow steadily, proving a counterintuitive point. Moral discipline often outperforms reckless ambition. But even Buffett faced criticism. In an industry obsessed with glamour and instant results, humility and ethics are sometimes treated as weaknesses. Analysts questioned whether his slow approach could scale forever. The public didn't fully understand that wealth, when built on a moral foundation, compounds with both money and trust, two currencies far more valuable than fame. Many investors, seeing Buffett's success, tried to imitate him but often failed. They copied his stock picks without embracing his moral framework. They leveraged heavily, speculated, or ignored the importance of understanding the businesses they bought. Without ethics as the anchor, value investing becomes just another gamble. The lesson is subtle but crucial. The tricks of wealth aren't transferable if the underlying principles are ignored. Buffett's code isn't about formulas. It's about character, patience, and judgment. Copying numbers without the mindset is like trying to build a house by only looking at blueprints while ignoring the foundation. Fast forward to today. Markets are flooded with high-frequency trading, meme stocks, crypto frenzies, and AI hype. According to a recent survey, over 60% of retail investors lose money within 5 years of entering the stock market. Why? Short-term thinking, greed, and neglecting risk. Buffett's moral code remains relevant, yet ignored. He warns against debt, overconfidence, and speculation. Modern parallels are startling. The GameStop frenzy, the crypto crashes, and leveraged ETFs show the same patterns as the dot-com era. Investors repeat the same mistakes, believing speed and hype beat patience and ethics. Buffett's approach works not because he predicts trends, but because he refuses to compromise his principles, regardless of the noise. Integrity, discipline, and understanding are timeless shields against the cycles of boom and bust. So what can you learn from Buffett's moral code? Wealth without ethics is fragile. Profits gained through shortcuts or manipulation may grow fast, but often collapse faster. Buffett's disciplined approach shows that longevity matters more than immediate gains. Understand what you own. Never invest in something you don't comprehend. Knowledge is a moral obligation to yourself and those who rely on you. Blindly following trends or influencers is a betrayal of both money and judgment. Patience is a moral act. Waiting, resisting temptation, and allowing compounding to work is more than a financial strategy, it's a reflection of character. Ethical patience is as powerful as financial acumen. Here's the warning: in a world addicted to instant gratification and speculation, ignoring these principles isn't just costly, it's dangerous. Many investors today believe that cleverness or technology can replace ethics, but history repeats itself. Every bubble, crash, and scandal proves that moral discipline is not optional, it's essential. Ask yourself, are your financial choices guided by principles or by impulse? The answer may determine not just your wealth, but your peace of mind. If you want to invest like Buffett, don't just copy his portfolio, embrace his code. Study the companies, understand the risks, practice patience, and let integrity guide every decision. And if you found this insight valuable, hit the like button, subscribe, and share this video. Wealth without ethics is a lesson learned too late, but knowledge, when shared, can change the path of countless investors. Remember, money can make you powerful, but only moral discipline makes you wealthy in the truest sense. Warren Buffett didn't just build a fortune, he built a legacy, proving that ethics and profit can coexist. The question is, will you follow in his footsteps or repeat the mistakes that history keeps warning us about?